Welcome, everyone, to the Institute for Corporate Governance and Ethics Spring 2025 Speaker Series. I'm Todd Haw, Associate Professor of Business Law and Ethics at the Kelley School and the Faculty Director of the ICGE. And I'm thrilled to be joined today by Maria Sunta Giannetti, the Katarina Martinson Professor of Finance at the Stockholm School of Economics, who's going to talk to us today about environmental, social, and governance, or ESG, targets in executive compensation. But before I formally introduce Maria Sunta, I'd like to say a quick word about the ICGE. The Institute for Corporate Governance and Ethics was reimagined and relaunched earlier this year with the aim of taking a broader, more interdisciplinary, and more systems-based approach to corporate governance research. Not only did we want to ensure that we were considering governance issues from numerous areas of research, including traditional finance and management, but also corporate law, corporate compliance, business and behavioral ethics, and financial controls. And we also wanted to make sure that that research was accessible to business practitioners. So as part of that relaunch, the ICGE acquired a center called Ethical Systems from NYU Stern, which doubled the number of our research affiliates, our faculty affiliates, and brought an entirely new network of collaborators under the ICG umbrella, as well as a whole new platform to reach business leaders. So we also renamed the Institute. We added the ethics to our title, which is a recognition of the importance of ethical decision-making and behavior to positive and effective corporate governance. So our new mission is to harness the best academic research to aid scholars, policymakers, and business leaders in elevating corporate governance and ethical business practices within their firms. And instead of focusing just solely on academic theory, the ICGE's goal is to advance governance and ethics know-how in business. So please stay tuned for all kinds of new initiatives and activities coming from the ICGE and Ethical Systems in the future that will further our goals. And today is a great example of what we're hoping to accomplish because Maria Sunta's work explores classic principal-agent problems that are so often at the heart of corporate governance issues, but in the context of a very timely and practical look at ESG pay metrics and their effects. And as I mentioned at the outset, Maria Sunta is the Katarina Martinson Professor of Finance at the Stockholm School of Economics, a CEPR Research Fellow, and a research member and fellow of the European Corporate Governance Institute. She holds a PhD in economics from UCLA and a BA and MSc from Bocconi University. Her research interests are very broad, covering topics such as production networks and trade credit, banking and monetary policy, financial integration, and of course, corporate governance and sustainability. Her work has been published in numerous leading journals, including the American Economic Review, Journal of Political Economy, Journal of Finance, Journal of Financial Economics, and Management Science. And on many of these journals, she has held editorial roles, and she has also served as the director of the European Finance Association, the Financial Intermediation Research Society, and the Financial Management Association. So not surprisingly, Maria Sunta has garnered a number of international recognitions, including an ECGI Fellowship for Scientific Excellence in Corporate Governance Research, the Asser Lindbeck Medal, the NYU Stern Imperial Fordham Rising Star in Finance Award, the Review of Finance's Pagnio-Zechner Prize, and a host of others. So I could certainly go on, but we'd run out of time if we listed all of her accolades today. So with that, I'd like to welcome Maria Sunta Giannetti to our Spring 2025 Speaker Series.
Thanks a lot for having me and for the very kind introduction. So I am very pleased to be here with you today. And I think that the topic fits very well the new broader objective of the Institute, because I would like to share with you some thoughts about executive pay, but also how we can incorporate the sustainability issues in executive pay. And this is an ethical component. So let me take a bit broader view. what do we generally say about the CEO compensation? What is the gold standard, and what is the prescription that a finance professor would give on a compensation committee? Well, our prescription is that the compensation of a CEO should be linked to companies' financial targets. And at the end, what we think is that the stock price should be a sufficient statistics of a corporation performance. And this works very well if we think of a company value as being the discounted value of future dividends. But what if we want to incorporate also other considerations like the environment, diversity or inclusion, and so on? Well, if we think that the shareholders of a companies have preferences that such that they would sell the stocks or demand less of it if the company doesn't pursue certain ethical target, we don't need to give more metrics. But sometimes there might be trade-off between environmental and social targets and financial performance. So in this context, giving environmental and social metrics, sustainability metrics as a target to the CEO might be optimal. There has been, however, a heated debate about these environmental and social targets. Why? Well, it's very hard to say whether these targets are a part of an optimal contract that reflects the shareholder preferences. In principle, as some say, this ES target might just contribute to increase CEO pay. So Berchuk and Tallarita have a paper in which they say, well, this is another manifestation of CEO power. Could we look at whether companies that, for instance, give environmental target reach this target to decide whether the contract is optimal? Well, it is hard. Why? Well, because targets are chosen endogenously, so we don't know whether the board gave an environmental target in order to, because it knew some investment had been done and this would improve performance, or the board might give an environmental target when the company is in very bad shape from the point of view of emission. That's hard to reach, but at the same time, this doesn't mean that it's a manifestation of CEO power. So how do we look at it? And the literature on this contest is small, but has very mixed evidence on whether companies in which the CEO has environmental and social target indeed perform better on this dimension. So we were curious to look at the evidence and the data. And when we started to approach the data, we noticed some very stark facts. Companies have a lot of targets when they have these for CEO contracts, meaning that academic research on compensation has so far focused mostly on ex post payout, the sensitivity of compensation to price changes, profitabilities, and other measures. But, and we have somehow neglected the fact that there are metrics that justify the awards. What about these metrics? Well, as you can see from my figure, basically, almost all global listed companies have some executive pay metrics. And what you observe is that both in the EU and the US, we have seen in the last few years not only an increase in ES metrics, but also an increase in operating metrics. So in our view, what we do in our work is trying to understand jointly when metrics are used, and we try to understand whether the environmental and social metrics are different from the rest of the metrics. Let me give you a short preview of where I will be going, and then I will show you the detail of the data and a bit more flavors about the test. So, to the best of our knowledge, we provide in this paper the most comprehensive description of executive pay ESG metrics. How? Well, we use a textual analysis and we classify the metrics according to the classification of the sustainability accounting the sustainability accounting standard boards. The good aspect of this classification is that we will be able to say what kind of metrics are material, relevant for a given industry. So for instance, emissions might not be material for banks. Why? Because in its own business, scope 1 emissions are very low for the service industry. So the classification of the SIBS allow us to capture this aspect. But importantly, what we do in our paper is that we don't only look at sustainability metrics, we look also at the other metrics, that is operating metrics, earning metrics, and market metrics. And we look at how companies use metrics in all together. What we find is that ESG metrics in this respect do not look special at all. Their use is very correlated with the use of market earnings and operating metrics. And importantly, it looks like that companies that use metrics also use equity-based compensation. So according to classic compensation theories, those are the most sophisticated contracts because compensation is related to corporate valuation. But this apart, the evidence that the award of the metrics follows standard theory is very mixed. Meaning that, well, the stock market performance, the valuation of a company and how it changes over time should give us a signal of how well the executive team is running the company. But sometimes we know that there is a high market volatility. We do observe that ESG metrics and operating metrics are relatively more used in these instances. But on the other hand, we don't observe a trade-off, for instance, for earning metrics. But more important, the reason why it doesn't look that metrics are awarded to direct CEO efforts to certain goals is that we observe very limited influence of the metrics on the actual payout to the CEO. We do not observe that a CEO actual pay sensitivity to ESG performance increases when there are some metrics. Or, for instance, the presence of ESG metrics doesn't decrease the sensitivity of pay to the company's stock market performance. So this leaves us a bit perplexed. Why are CEO given these metrics? So we propose and test a new hypothesis. Metrics are a way to inform shareholders of corporate strategies. And we know that in all companies around the world, shareholders have a say on pay. That is, they have to vote to approve the compensation package. Boards care, even if, as in the US, this is mostly an advisory role. So what we observe is that companies that have more disclosed metrics have relatively more support in their say on pay votes. And actually, companies that have experienced dissent about their compensation contract are more likely to introduce metrics, okay? So, or increase the number of metrics. So it looks like that this is a way to explain the contract to shareholder in order to limit the extent of opposition to management. And this objective of the metrics is not only limited to explain to shareholders the compensation contract. What we observe is that the companies with more metrics receive fewer shareholder proposals that are opposed by management. So these would be shareholder proposals that are at odds with the corporate strategy. And in particular, companies that have ESG metrics are less likely to receive ESG proposals. So the way in which we interpret this evidence is related to some work that Nick Ganchev and I have done a few years ago. There is evidence that some of the shareholder proposals that reach the shareholder meeting are ill-conceived, meaning that if they receive shareholder support above 50%, they destroy shareholder value. Why would we care? Shareholder proposals are generally just advisory. Well, there is a lot of evidence that we also provide that for reputational reasons, directors want to be seen as complying with shareholder consensus. So some of these shareholder proposals end up being realized. Also, even when shareholder proposals do not pass or pass are not implemented, they end up wasting managerial time and energy, meaning that the management has to build a coalition, explain why some governance or sustainability proposals doesn't fit the overall corporate strategy. So having more information and transparency about the corporate strategy may improve the way in which the company is run by preventing or reducing shareholder proposals that are ill-conceived. But in general, what we observe is that the companies with more metrics have more consensus on the corporate strategies from the shareholders. So this is basically the story that I am going to give. To relate this to more policy and corporate practice, I just want to share you some piece from McKinsey. So what has been happening during the sample period and is for sure still happening on my side of the Atlantic is that investors want to hear from companies about sustainability. And by giving these sustainability metrics, what boards can do is inform shareholders about how they are incorporating sustainability issues in the corporate strategy, preventing opposition. So this is the story that I am going to give you, and perhaps it might be a good time to ask whether there are some question of clarification that you would like to have before we move on. And I am afraid, yes, please.
I think that's a perfect time. Thank you, Mauricio, just to pause for a second. And I'll just remind everyone, please feel free to type your questions into the chat, and we'll try to take those as best we can and get to them throughout. I just want to ask a clarifying question. I think you're going to get to this, but this idea of sort of a signaling mechanism that your metric might be used for. The biggest issue, at least right now, is DEI, thinking about kind of the rollback of DEI. And so I want to just ask you a clarifying question. Does the ESG metrics that you looked at, did it take into account kind of DEI related metrics?
Oh, yeah.
Okay,
yeah.
So I'm happy to hear just a minute on that, and then
Yeah. Yeah, and actually is DEI has been the most frequent metric, and I will show you in a moment, okay? But let me tell you where these metrics come from, because of course the companies that are listed in the US have all these homogeneous filings that tend to disclose the metrics, but we have a sample of global companies, and it's interesting that these patterns are overall pretty homogeneous if we look at the US or European Union plus UK. Okay, so basically we get some data from the institutional shareholder services. This data include the normal item of compensation, but they include also a textual field that basically we read both just reading it or performing textual analysis to classify the metrics. So it is doing this that we notice the prevalence of metric across the board. So there are earning metrics that may include profitability or cash flows. There are market metrics, of course, share price performance, shareholder returns. Operating metrics are typically connected to the objective that an hedge fund activist and private equity investor would have. So capital structure, efficiency, investment, sales, or sometimes the completion of specific projects, improving customer satisfaction. That is what we put in this category other. Now let's come to the ESG metrics and how we classify them. So we use, as I said, the Sustainability Accounting Standard Board classification that is actually very detailed. And these are the data, the way they look like before we classify them. But let's go to what Todd was asking. So what you observe here is the decomposition of the ESG metrics. And this light green booming objective is DI. Okay. So as you can see, it is employee engagement, diversity, and inclusion. I understand that in the United States, diversity might become very, very unpopular. But I was reading on the Financial Times that companies are changing the labeling from diversity to inclusion. So we are aware that here would be very interesting to expand the sample period.
That may be your next paper very soon.
Yes, precisely. And
That's
also
right.
the way in which, these metrics respond to the public sentiment, the political polarization, and so on. But what you can see is that these sustainability metrics may regard many other topics, okay? And the classification of the different categories are the one of the Sustainability Accounting Standard Board. Okay, and just reading, we selected the label that we thought was closer to the metrics that we observe. The reason why using this classification is very useful for us is that we can measure performance really along these metrics. How? Well, we purchased a data set from FactSet. So what the FactSet does is that it uses AI to explore a huge number, I'm writing here 200,000 vetted sources. That can be newspapers, blog, NGO website, to evaluate the performance on each of the SA sustainability accounting standard metrics of companies. So we get a score for the overall ESG performance of the company, for the performance of the company on material ESG metrics, but also at the metric level. And this enables us to study how the metrics are selected. Do companies select metrics in which they are doing particularly poorly? We don't find any evidence of that, even though our intuition of the theory would have told us, well, perhaps the board should emphasize aspects in which the company is currently weak. So the score is updated daily. So since compensation is yearly, of course, we aggregate at the yearly level. But the score reflects the sentiment of the language of these news. Okay, so this enables us to really look at the performance in a very granular way, and it enables us to look at performance before the introduction of the metrics and after. And then, of course, we use other data sources to have information on the proposal, shareholder votings, company ownership structure, and of course, the standard company financial. So something that you might be interested in is that, so this is the pattern of the metrics during our sample period. And what you observe is that they have been increasing, and the use of what SIBS call material metric has been as frequent as the use of non-material metric. So we don't observe a switch to the use of non-material metric just because during this sample period period it became popular or demanded by shareholders. I already showed you the explosion of DI. So, and what I want to show here is also how these metrics reflect the different aspects of the way in which a company is run. So during this sample period, also operating metrics have been increasing. And the operating metric, there are a lot of non-standard operating metrics that are too variegated to be classified according to capital structures, efficiency, and so on, and we put under other. And then you observe that this yellow line is also been trending up.
Marisunta, before you jump into that,
Yes.
I did have one. Received one data question here that it sort of makes sense now that you're talking about metrics. So Raj is asking how Net Promoter Score might be considered under ESG. So his question, I think, is NPS is generally an approximation for customer satisfaction. And it sounds like, and so he's asking, do you have this as a customer satisfaction metric or an operation metric or an ESG metric?
Yeah. So yes, sometimes the differences might be subtle, but the customer satisfaction is considered an operating metric, is related to operation, is closer to sales, right? Then, of course, there are other metrics that are related to business ethics or competitive customer privacy, okay? That is more a sustainability metrics, is not relatively directly related to sales, okay? But regarding these ESG metrics, this is what the sustainability accounting standard so the Sustainability Board says, okay, so SIBS. While this is our classification, and we think of customer satisfaction more related to the operation. So the customer,
Thank you.
Yeah. So are ESG metrics special? So this is an initial piece of evidence to tell you that they don't look special to us. What you observe here is that whether I control for financials or not, I observe that companies that use ESG metrics, regardless of whether these ESG metrics are material or not, tend to use a lot of the other metrics. So this seems to be more a characteristic of the style of the company. And we also observe that the companies that use a lot of metrics have more equity compensation. This is true also if I exclude the market metrics, because one would think, well, a company with equity compensation has mechanically more market metrics. So the contract is sophisticated, and the presence of these metrics seem to reflect a sort of contract complexity. Then we try to see, first we don't use the granularity of our classification. We just ask which company have one, at least one ESG metrics. And something that makes sense from the point of view of contract theory is that the companies with a very volatile return use more metrics that are not subject to market volatility. So they use relatively more ESG metrics. And we also observe that these ESG metrics are introduced when there are new active shareholders that that purchase the stocks of the company. So this is very similar to what we observe for operating metrics, and is related to what we know from the literature on hedge fund activism and private equity. We know that this kind of investors tend to interfere relatively more with management and give objectives that aim to achieve better performance. So in this respect, these metrics are akin. So, but we can do much better with our data, because we not only know whether a company has an ESG metric, we know what kind of metric a company has. So if you look here at my number of observation, now the number of observation is much larger, because I don't have only the firm and the year, but for each firm and year, I observe which metrics a firm has. And what you see is that given their industry, companies are more likely to introduce metrics that are relevant. So these are the metrics that for that industry are considered material from the Sustainability Accounting Standard Board. And we also observe that this is particularly likely when companies have overall low ESG score. So this would suggest that these ESG metrics aim to improve the sustainability policy of the company. But we also find something that at first puzzled us. So we look at how a company introduces a new metrics. And we were asking, well, perhaps a company should introduce a specific metrics if they have been doing particularly well on that dimension. So companies that have been criticized for poor diversity should include the DEI metrics. Companies should include metrics related to the emissions if they have particularly high pollution levels or were caught in some incidents. This is not what we observe. So what you observe here is a positive correlation between our metric-specific news index and the probability that that specific metric is introduced. So what this tells you is that a specific ESG metrics appear to be introduced in the executive contract in the year after the company has experienced a relatively good performance on that particular metrics. There is some recent work by Alex Edmonds and Dirk Genter that who performed a survey asking board how they compensate the CEO, what are their objectives. And what they find is that these board members seem to say, well, we want to give fair compensation for good performance. And that this positive correlation seems to be very related to that. And indeed, we do not observe that after incident that on a particular aspect of sustainability, for instance, a scandal for discrimination, a company introduce ESG metrics. We capture here with this particularly bad metric-specific news. A company that has experienced particularly negative sentiment on some specific sustainability metrics won't introduce that metric next year. Okay, so this is so is these companies introduce metrics on which they are doing relatively well. The metrics are material. They are material also in companies with poor ESG scores, but if a company is doing terrible, is not highlighting that in the compensation contract. Do firms improve their ESG performance after introducing the metrics? And of course, we know that companies introduce a particular sustainability metrics after doing well. That could be simply a trend. So the way in which we try to do this is that we look at the news, we look at the coefficient on the first ESG metrics that on when an ESG metric is first introduced, and we control for the news during the previous year. So what we observe is that even controlling for the previous performance along that particular metrics, companies that have recently introduced a particular sustainability objective do relatively better along that metric. Okay, so this is, I wouldn't interpret this as causal, because when the metric is introduced, of course, the CEO and the board know about the initiative that have been taken. But at least we do not observe that these companies do worse. So we have a lot of other descriptive evidence of on these metrics, and as I was saying, is that the operating metrics look pretty much to have similar determinants to the ESG metrics. So also, for instance, operating metrics are introduced when market performance is volatile and seem to be introduced by the arrival of private equity investor and fund activists. Also when I look at operating metrics, it is not clear that these metrics are introduced when the board wants more effort on a particular dimension, meaning that the evidence is mixed. It does look like that companies that have lower cash flows or sales of than their industry peers tend to have more of these metrics in the compensation contract, suggesting that the board would push the company in this direction. But we also observe that companies that have high profitability also have more profitability related metrics. So there is, it's unclear whether these metrics are there to direct efforts to specific targets. And actually, when I look at the way metrics affect the compensation, this reinforces this impression that we get from the descriptive evidence. Let me give you some idea of the empirical tests that we perform. Of course, in our data, we observe the payout to the CEO. So we have the total compensation, we have variable compensation. So this is our dependent variable here. So what do we try to do? Well, we have a metric level measure of compensation, okay? That is what we call this metric news. We ask to what extent a CEO receive larger payouts when it has performed particularly well on the sustainability metrics that was highlighted by the board. And we find very weak evidence that this matters. So what you observe here is that CEOs are always rewarded for good sustainability performance. This is captured by this variable, all category pulse news. This is the sentiment of the news covering the CEO sustainability performance. Higher payouts is a strong result whether we look at the total compensation, variable compensation. But when we look at the performance along the specific metrics that are that the board gave to the CEO, the effect is much weaker. There might be a small effect on the salary, but we don't find anything when we look at stock option award, stock award bonuses, okay? And if you compare the coefficient, good performance on the metrics that are contractually written has a much smaller effect than overall good performance, okay? You might want to also notice that, so these are the dummy on whether the contract presents metrics. Contracts that have market earning and operating metrics tend to correspond to higher payout to the CEO. Having a ESG metric doesn't add much, okay? So of course, boards want to explain more and give more justification in the presence of larger payouts, but they were already doing so. The ESG metrics don't change anything, but they also don't change the way the CEO is paid. And we tried to produce evidence in all possible way. So for instance, we were looking at whether the presence of ESG metric reduces the sensitivity of pay to market performance. No evidence of that. So this begs the question, why do this firm use these pay metrics and ESG metrics in particular? Okay, so if you have questions, please ask, or I can take a
This is a good time to break. I mean, so it sounds to me like the pay. I mean, is pay just based on a vibe? Like what's going on here? What's the real driver of our executive pay if it's not tied specifically to the metrics, or at least meeting the metrics in a way that we would sort of traditionally expect?
So, and this is what I am trying to answer now. So that, so why do firms use pay metrics? So what we know is that there is, since Sarbanes-Oxley, these shareholder votes on the payout to the CEO. And this is true across the world, okay? So we ask, do we observe, what is the shareholder support for in these say on pay votes? Okay, of course, we know from previous literature that shareholder support depends on how large the payouts are. Shareholders are not very happy if the CEO is paid a lot. It depends on previous market performance and so on. We have all these controls. We can reproduce the results of previous literature. We have more support if there is a good coverage of the company about the sustainability. But interesting, we find a very significant effect also for the metrics. Companies that have relatively more metrics in their contract, they explain better to shareholder, have a higher mean say on pay vote in the shareholder meeting. So lower likelihood of shareholder dissent. Another way to see this is to look at a different outcome of shareholder vote. Now I am not focusing any longer on say on pay, but I'm looking at how shareholder vote on managerial proposals. And my dependent variable is the proportion of votes against management in these managerial proposals. And what you see is that, again, there is less dissent. The proportion of votes against management is lower when there are more of these metrics. I can provide you more evidence. What you may say is that, look, but you are starting from the say on pay vote. Of course, it increases, but is this economically relevant? We know that these say on pay votes generally pass. In the US, they have a very high support. And in general, what I'm showing you here on my slides is that the average approval rate of the pay package is 90%. So we look at say on pay in a bit different way. There are some situations in which there is high opposition against the pay to the CEO. So we capture this using the mean say on pay vote against the compensation package. And we also look at the average opposition on a rolling window of 3 years. So this is really shareholders that don't like compensation in this company. And what we observe is that the number of metrics at a company increases after facing shareholder opposition. So is also the timing of the introduction and the increase of these metrics is consistent with my narrative. Okay, so this is when the boards observe this shareholder dissent about the contract, they try to explain more. There is a bit more evidence that we can provide. So, for instance, do ESG metrics matter for ESG proposal? And what you observe is that in general, ESG proposals are submitted to companies that are not performing well on sustainability, that are receiving negative news coverage. But having a ESG metric and controlling for the news coverage of the sustainability policy of the company also decreases the probability that these shareholder proposals are submitted. So to some extent is a way to prevent shareholder pressure. And this is true for the ESG metric, but is something that we observe in general for all the metrics. Companies that have more metrics receive fewer shareholder proposals and receive fewer proposals among those that the management doesn't like. That is, management provide a recommendation when they receive a shareholder proposals. And the proposals that are more contested and sometimes might be considered more ill-conceived are those that the management generally recommend voting against. So through this metric, the management reduces the level of trouble in the shareholder meeting, increases consensus. So let me wrap up, and then I would love to engage more with your question. What did I show you? In general, what I think for when we think of executive compensation, I think both in academia and in practice, we have been looking a lot at how sensitive the compensation is to performance. But there is a wealth of information in the contract that explain why the CEO is being paid. That is in general important to understand the corporate strategy, okay? And this might be well beyond what we do in this paper. What we do in this paper is taking a bit this more comprehensive view to understand the ESG metric. And our conclusion is that we shouldn't be that worried, meaning that the ESG metrics are just a manifestation of what the companies have been doing for a lot of time. The board tends to explain shareholders why there are a payout to the CEO, why and how the CEO is compensated. This is the major objective of this is explaining to shareholders. If there is abnormally good performance, even if that particular metric was not contracted upon, the CEO is rewarded. So whether a ESG metric was already established in the contract or not, we observe that compensation increases for good sustainability performance, but having this metric just with away some unwanted shareholder proposals. And thanks a lot for your attention, and I love to hear more questions, and I'll try to read a few.
No, that's great. I can pick them up here, Marisunta. So two questions kind of about how the metrics are defined. So one was from Patrick: how is a metric to be defined as material by SASB? I think he's trying to understand how that affects the analysis. So that's one question. And then Eduardo had a second question here about could the inclusion of ESG metrics be merely symbolic if their weighting is too small relative to other performance indicators? So they're trying to think about the difference in weighting between the ESG versus performance. So I don't know if you can pick up either one of those two questions.
Yeah, I will try to answer both. So we don't have the weighting, so there could be this sort of symbolism. So what I have shown is that this symbolism matters for what happens in the shareholder meetings, for shareholder propensity to intervene through shareholder proposals, and having these metrics helps to build a consensus just because there is more information on what were the objective of the CEO strategy, okay? So it's a symbol that doesn't matter for the payout, but it matters for the way in which shareholders look at what the CEO has achieved and how much they try to interfere. Now, regarding Patrick's question about the SASB, so when we think of sustainability, is of course the business of a company implies that the challenges are different. Is for banks in the for the finance industry, is DI issue might be relevant. But if you think of scope 1 emission, that is emission that are produced in the normal operation of the company, that is irrelevant for any company in the service sector. don't burn any oil or gas, right? It would be just related to the air conditioning, and it is a tiny number. So that is the intuition of what the SIBS is doing. So if you think of a company in the mining industry, or for instance, also companies in the fashion industry, perhaps waste can be very important. And then the sustainability policy is how to do recycling, how to limit waste, and so on. But in those kind of industry, perhaps DI is less of a concern. But the way in which this materiality can be defined, of course, is very important for the production processes, because there are industries in which waste is not a concern, but is very important to have a technology to cut emission. There are other industries in which the supply chain might be very opaque, and sourcing inputs that are sustainable from suppliers that have sustainable labor practice is particularly important, while there are industries with more domestic supply chains. So that's what SAB is trying to do.
Great. Thank you, Marasunta. Well, unfortunately, we'll have to wrap up here. We've hit our hour mark. I know we could go on forever. A lot of questions, and just really, think about the practical questions about, how investors and boards should consider this research. But we'll stop there and save that for later. And we just want to thank you so much for the great talk. I'd also just highlight, for those of you who are interested, the ICGE Speaker Series, Spring Speaker Series continues. In March 6th, Lauren Cunningham from University of Tennessee's Business School will be with us. April 3rd, Andrew Jennings from Emory Law School will be with us. And then we have Allison Taylor, who will be talking about her book, Higher Ground, in late April. So with that, thank you very much, and have a good rest of your day.